Loan modifications really became popular in 2009. President Obama introduced what's now known as the HAMP program, which stands for Home Affordable Modification Program. That program is really there as a tool for homeowners not to lose their properties. And in theory, what it's there for is to help preserve the home for the client, and it's truly a negotiation of an existing mortgage. So a little bit different from a refinance. It's more there for you to be able to negotiate more favorable terms on the current mortgage that you have. The modifications are there primarily for the benefit of the client, but they're also there for the bank. It's to ensure that that contract is honored at some point. In today's environment, that program has evolved into something that is very big. There are various different types of modifications. There are different investors that actually adhere towards HAMP modifications, and today most banks have their own internal modifications. Each modification has a series of guidelines that are utilized and different qualifications. So it's extremely important to really understand the type of modification that you're applying for and the type of modification that you're going to qualify for. And that's really what we emphasize when we're doing modifications is who is the investor behind the loan, who is the bank, what is the type of modification that is really going to get the best negotiated terms for our clients.
Basically, it's a hardship program to keep you, and it's a program to keep you in your home. What happens is you have a couple that's married. Let's say you have a joint income of $100,000. You're paying your bills. Everybody's happy. Let's say your husband loses his job. That income is going from $100,000 down to, let's say, $50,000. You know, now you start to feel the pressure. Now that mortgage you were paying, you can no longer pay easily. So instead of selling the home, instead of going to foreclosure, you know, we can go in and we can renegotiate terms with the bank to make the payment more affordable. You know, with that being said, it would entail, you know, us lowering your interest rate, lowering your principal balance at times. The goal is to make sure you have a payment that you're comfortable with, a payment that you can afford. That payment can be for the next 5 years, that payment can be for the next 30 years. It's all about the negotiation. What makes us successful at this is our relationship with the banks. I mean, I've been in the banking industry for the last 15 years, and we have relationships established, and we have the partners in place that, you know, they really want to help. At the end of the day, the bank doesn't want to take your home. You know, I mean, that's you know, contrary to popular belief, the bank isn't in business to sell real estate. They're not in business to take your home back. They want you in your home. They want their monthly payment. So if they're used to getting $2,000 a month from you, now they're only going to get $1,200 a month. But we'll spread that time out longer. They're still made whole. They're still making their money. You're still in your home. So at the end of the day, as long as we can meet in the middle and make all parties happy, you keep your home, the bank keeps, you know, getting payments. You know, it's a win-win.